So everything discussed here is not financial advice as usual. It's purely for educational basis. Do read the disclaimer. Let's start off with a bit of price action analysis. I wanted to give you a brief of the market overview because as we go in the next 2 months before year end, we want to understand if anything has changed significantly from before and understand the latest backdrop of what financial markets are looking at. So something that's been topical over the last few weeks has been the US bond market, particularly at the long end of the yield curve. So with the Fed cutting rates sometime in October, or no, sorry, was it in September? This is probably an unexpected move for the vast majority of financial market participants. So basically what we are saying is from a month ago, the long end of the curve, which means, let's say 3-year above to 3-year and above from 3, 5, 10, 20, 30-year rates, they've all been moving upwards. So that's a bit problematic for some stocks, especially the ones which are long duration stocks like tech stocks or stocks that really need interest rates to be lower. And it's been a big headwind for a lot of these stocks. And also it was kind of unexpected, but for guys who were paying attention, we were, far ahead of everyone in this move. So basically what is happening, according to me, is that the market thinks that the Fed has almost kind of ditched the 2% inflation target and is now focusing more on rescuing the job market. So on Friday, we saw a pretty dismal employment report with the non-farm payrolls, and that actually revived all the bets for the Fed to cut interest rates in the next meeting. So that doesn't bode well for the long-term inflation rate, because if the Fed is going to be overly dovish, it also means that in the long term, we should expect long-term inflation rates to creep up. So it might not be a big deal if inflation rate moves from 2 to 3% in the short term, but if it's consistently above the 2% target, let's say by 0.5% or 1%, that's quite significant over the long term. And this is basically what's happening here. So we see mortgage rates also that are not coming down, and that's putting a lot of stress on housing stocks. We'll see later what's been the price performance of home builders and related stocks. So that's a big component that is only now surfacing in the market. We've been talking about this from at least 6 to 7 weeks or even longer, if I'm not mistaken. So this would not be news for a lot of the members. Just quick look at what US equities have been doing. So the S&P had a relatively bad week. So it's part of a big roaring bull market move, right? So one bad week means nothing. It's still very close to all-time highs, but we still have to take into consideration the dismal week that it's had. And that predominantly came through when we had the large caps reporting. So as an example, the results haven't been that great for companies like FedEx, Microsoft on, was it Friday, when they warned about the revenue from their cloud segment. So that doesn't bode well for these stocks and also for the stock market, because Microsoft, for example, is thought of as a bellwether stock, right? So people will look up to what Microsoft has to say regarding current conditions and also future outlook to base their views on what's going to happen to a lot of other stocks down the value chain. So Microsoft also gives you a very good understanding of what spending is like from the small, medium, and even the large enterprises. And for them to be warning against not a so great outlook, I think that says a lot about what they are seeing firsthand based on the vantage position that they happen to be in. Another one to look at is the IWM. So we've been looking at this for quite some time, and obviously we've had a breakout to the top, and then not really had much. So it's been a relatively, let's say, sideways move above the resistance level turned support level, which is the blue line in this case. And since then, it's been hard for these small cap and micro cap equities to rally quite significantly. A lot of companies have rallied a lot, but at an index level, we haven't yet seen proper clean breakouts. That doesn't mean we're not going to see it. It just means that we probably need to be a bit more patient. More interestingly, the QQQ, so NASDAQ, it's almost looking like it's putting in a double peak, so a double top. I think that's quite worrying because there are no investors who are willing to take the NASDAQ to a higher high. We're not just talking about it from a technical analysis perspective. We started off with the backdrop for long duration assets. And the NASDAQ is full of these types of stocks, so tech stocks, software stocks, and a lot of companies that are probably not yet generating profits and still in the revenue growth phase and are quite, I would say, richly valued on that metric. They form part of the NASDAQ. And of course, if the long end rates are not coming down, NASDAQ will also come under a lot more pressure. And this is literally what we are seeing. And this week has been a resumption in the increase of the VIX index. So this is the volatility or projected volatility for the next month for equities. Coming into this quarter's earnings, what we saw was that volatility picked up quite a bit for a lot of individual stocks. And that's indicative of the market being aware or even wary that there's going to be a lot of changes within this earnings season. So we've seen GDP slow down over a couple of quarters, and I think it's pretty evident to be assuming that we'll see that being played out through corporate earnings as well. And corporate earnings would tend to be a lot more leveraged than what you see at the broader GDP level index. And you can see it through many of the earnings that we've been looking through. Huge beats, huge misses, and there's a lot of dispersion in the market. So this is the perfect opportunity or environment for us as long-short traders, because it means that if we're able to get the right long ideas and the right short ideas, we'll be having a portfolio that's almost uncorrelated and generating returns on both long and the short side. Just a bit of factor analysis. So we've been discussing this quite a bit. What we're seeing is the small cap stocks are still in strong favor with the market. It's been a strong outperformer. Even if we haven't seen the IWM breakout cleanly, on a relative basis versus the S&P, it's still outperforming quite strongly. What we are also seeing, and it's a theme we've been identifying from, let's say, the last 6 weeks, it's almost like a rotation of capital out of large and mega caps. So this week showed us that large caps have probably got more weakness, and this might come through as we have more earnings within this space. So one of the themes we need to be looking out for, especially as we get into the year end, is rotation of capital out of richly valued large cap stocks. That could take many forms. It could be people taking profits. So one of the things I've been suspecting from a few weeks ago was that funds have had relatively good year-to-date returns so far, and their bonuses depend on that, which means they're not going to take silly risk in the next couple of months to actually put that at risk. So the funds will be playing it very defensively, and there's almost no incentive for them to go out and take more risk into their portfolio. And I think going into November and December, we'll be seeing a lot more of this. A lot of funds will either just be taking profits and staying with high levels of cash or getting more defensive with their setups, or if they are going to deploy capital into new ideas, they will be into ideas that are more from the value type of segment. So low PE value, small caps, mid caps that have been kind of not necessarily been in favor or even overlooked by the market and the large number of participants out there. So that's kind of the backdrop in which we are getting into. And it's important for us to keep that in mind because even if we're going into year end, we'll still be trading quite actively in the next 2 months. So we want to be on top of these things. And if we identify certain trends, we want to be playing them in our portfolios and making significant returns out of these. At a sector level, so it's been a rough week. As you can see, most sectors were red. The S&P itself was down 1.38%. So compared to that, you'd say 4 sectors were significant outperformers. But even amongst the significant laggards, not outperformers, but even amongst the outperformers, you can see that quite a few of them were still yielding negative returns on a weekly basis. So from my perspective, I think we're starting to see this profit-taking trend that I was discussing earlier. So we see a bit of a reversal of the rallies that we had seen in utilities and the real estate sector from a few months ago. It's also been a tough week for tech, and that's to do with the long-term rates getting higher and also fundamentals becoming weaker for many companies in the tech space. One thing that was quite interesting was that we finally saw the industrials and materials sector, which might have peaked, so basically reached the top. And that's coming on the back of many months of the ISM PMI reports indicating contraction. So you would remember a few weeks ago, we were like, okay, we're getting negative or contractionary ISM PMI reports, but we still see the industrials and materials space just rallying in the face of these reports. But now I think there's a significant change in sentiment. And I think now what we've been discussing from a few weeks ago is actually about to happen. So if you're looking for short ideas, you could get 1 or 2 from these sectors, and they are likely to work out if you pick the right ones with the right actionable catalysts. So the only sector that had like a relatively strong performance would be the communication sector. I think there's a story underway there. We've been speaking about it with Lumentum Holdings as an example, where this whole AI technological transformation is creating a lot of demand for many companies that are involved in both hardware and software. And as you would know, let's say as an example, data centers, they require more advanced hardware to be able to transfer data in more quantities, but also at higher relative speeds to what they were used to in the past. Because with AI, there's a lot more data being created, a lot more data being moved around, and that's creating a big need for AI-specific hardware. And companies like Lumentum Holdings have been at the forefront of these moves. So for those who haven't seen my video on Lumentum Holdings, it's on YouTube. You can take a look. It's an idea that we've dug deep, and I think it's a very well worked out idea. If you're looking to find an idea or similar idea in the space, it's probably a good place to start with your research, so you understand what are the moving parts of such a business model. And in whichever company that you're looking at, you can kind of identify these same similarities. There are many companies within this space, so it's not just Lumentum Holdings. You've got Coherent, you've got Celestica, you've got Sienna, you've got a whole panoply of them. Broadcom, although Broadcom is almost like a mega cap and probably too richly valued at this point. The other question I would also have we seen a bottom in the telco capex? So many of you would remember during the study for Lumentum Holdings, we identified that the segment that was booming were the data centers. And they also have telcos as their clients, but that's a segment that's been significantly underperforming for months. And that was predominantly because of high inventory levels that had accumulated post-COVID. So are we now reaching that stage where inventory levels have come down significantly, and at the same time we're having a boost in capex from telcos as interest rates are coming down? Are we at that point where we have a confluence of a few factors that cause a lot of demand for communications equipment companies like Cisco? Although Cisco is probably not the one you want to play this theme with. There are more specific ones which are in the small and mid-cap segment, which will have significantly more upside. So many companies in this space, we can probably do a thread on this if actually there's something to explore there. So my observations here were predominantly the home builders. So as we know, the S&P performed quite badly on the week. It was down 1.38%, and the industries that are in the red box are considered as underperformers, and the ones in the green box are considered as outperformers. So let's start off with the underperformers, because there are a few interesting themes there that we can identify. So starting off with home builders, it's been a couple of weeks of relatively bad performance. So home builders have been selling off, and that's in line with the long-term rates going higher and higher. So what's happening there is a lot of optimism was priced into these stocks, as there was a lot of expectations that the Fed will cut rates, and that happened, but rates have not necessarily reacted as people would have expected them to. So as rates got higher, mortgage rates have also not fallen by as much as people thought. So it's not yet at the point where it's going to stimulate a lot of purchases or a lot of demand for housing. And the market is now suddenly coming to this realization that a lot of these home builders are probably priced a bit with too much hope in them. We'll also be having earnings soon, so keep an eye on this. There might be a lot of candidates ripe for shorting or even for going long. Then the next one, I think we've spoken, or I have spoken quite a lot about this. So oil services and oil and gas exploration and producers down massively. A few, maybe it was even 6 to 8 weeks before, when I was mentioning this to everyone, it's almost like everyone was ignoring me. So we were back in August, and I was showing you that, we have significant downside potential for oil services industries. And it's almost like no one wanted to listen to me. And now we're seeing that playing out. And I think there's a lot more to come. Keep in mind that these stocks vary quite a bit with the oil price. So I think another attack from Iran is imminent, and that will probably cause oil prices to go up, which could cause these stocks to rally a bit. But my whole point from August has been that all these rallies within these industries are to be shorted. So if we get a pop in a lot of these companies within these industries, do your work and figure out which are the ones that are good short candidates, and just try to get a very good entry point on your shorts. I think there's a lot of opportunity there. We also have the US elections that will eventually conclude soon. So if Trump comes back into power, it's likely that he would want a relatively low price for crude oil just to stimulate economy, stimulate consumer spending, and so on. So that's not going to be good for oil producers, because their revenue depend on the oil price. So keep that in mind. Within this segment, there are a lot of long and short ideas. So short oil producers, for example, but you could also go long refineries. Refineries basically make a margin between the gasoline price and the crude oil price. So assuming that demand for gasoline does not drop significantly, refineries will be able to still keep their margins or even increase their margins. And by virtue of that, I think it's probably going to be a good long. So do your work there. So my view on this sector is that companies that do not rely on the crude oil price for their revenue might be good longs. So as an example, let's say if you have a company that operates pipelines in the US, it's basically charging the clients based on the volume of oil or refined products that are moving through its pipelines. So nothing to do with oil price itself, although the oil price going up and down can influence the amount of volume of product moving in and out. But let's assume that that volume is not going to undergo a significant drop. And my view is that if we have a cut in oil prices, we might even see a stimulation in the amount of volume that moves around. Because remember, Trump wants the US to be a significant oil producer in the world. And that aligns well with what I'm trying to say in terms of a lot of volume of crude oil or even oil products moving around. And if you can find companies that benefit from a volume perspective, like pipeline companies, shipping companies, storage facilities, companies that have, let's say, crude oil as an input, as a raw material. As an example, if we look at airlines, they've been rallying quite significantly, and that's predominantly because the jet fuel prices are down as a function of crude oil prices coming down. So the margins for these airline companies are expanding thanks to a cheaper crude oil input price, right? Or jet fuel input price. So think about it from that perspective, because we don't just want to be short a particular industry. We also want to see if there are corresponding longs that we can have that will kind of hedge out the industry risk for us. A few others worthy of note. I think what I had in my notes were agriculture. So we are seeing consistent and underperformance of agriculture over a number of weeks. So I know it's in the outperformer box, but over a number of weeks, it's been like a big underperformer. So keep that in mind. Insurance sector as well. I think a lot of things are changing under the hood. So keep in mind that these companies have benefited a lot from interest rates being higher over the last few months, the last few years, and now that we're having a reversal of this, there's going to be a bit of repricing in this space as well. Another thing I mentioned was basically the gold miners. So we all seen the news that gold is rolling and it's making new highs and so on. And then we see a pretty dismal performance on a weekly basis for gold miners. That's the beauty of being around retail crowds. Whenever you have a lot of retail participation, this is probably a space you want to stay away from, or even take advantage of these retail crowds and be on the other side of the boat. But also, of course, it has to be fundamentally sound, right? So whenever you see something in the media, on Twitter and all that nonsense, like uranium is going to the moon, gold is going to the moon, and you see these stocks starting to rise, do not chase them, because when they reverse, because retail investors are relatively fickle-minded, they can wake up one day and realize, I want to sell this, or they read something, or for whatever reason, they'll be what we call weak hands, and you tend to have a lot of volatility within these spaces. So that's a word of caution for you. You can still play them, but of course be aware of this higher volatility risk. We see the same thing in uranium. A lot of stocks rallying quite significantly, and then they fall by 20-30%, and then they rally again. So if you want to really make money in these spaces, you have to almost be on the other side of the retail crowds. When they're getting out, you get in. When they are getting in, you stay away. And then when it feels like the stock has probably been overextended, you maybe short it, or you let it calm down, and then you buy the dip from there. So be clever. Don't just board the ship like others. It's a road to misery. Okay, I'll move on. So just a quick look at what's been happening across Europe. So again, another dismal performance on a weekly and even monthly basis for the index. It's been a relatively risk-off sentiment in Europe. And we can identify commonalities between European equities and the US equity space, that being materials, industrials, chemicals, tech, real estate, healthcare, autos, all having difficulty within, different, within their own respects, so some more than others. And we see these commonalities within the US as well. So keep that in mind, because as I said, as we go into the year end, we're going to have a lot of risk of behavior, a lot of profit taking, and probably a bit of deleveraging as well. One thing that I noted specifically was the sell-off in the food and beverage stocks in the EU. So this is something I wanted to mention because we are seeing almost a divergent thing in the US, with the ISM indicating that we've reached an inflection point, probably in the food, beverages, and tobacco segment. So, of course, we discussed a few ideas within this space, Ball Corporation being one of them. And many of these companies have high exposure to EU. It's probably 30-40% of their revenue coming from Europe. So keep that in mind if you're going long companies within this space, because it's not just going to be what's happening in North America. It's also what's happening in Europe and maybe in the rest of the world. The ISM PMI October 2024, it's now that we've discussed the September report in depth over the last few weeks, I think as you see these snapshots, it's starting to probably make a lot more sense, right? If I can maybe just get a sense from you guys, how were the previous sessions regarding the ISM PMIs, and when you're looking at these snapshots now, are these kind of making more sense, or is it still very cryptic and not very useful for you at this stage for idea generation? Give me a sense of how you feel about it individually.
I think that session really helped me, Roshan.
Mm-hmm.
I can definitely understand it a lot better now and follow your commentary on it now. Yeah.
I'm also finding it very helpful, and especially like reading the trends rather than the numbers on
Right.
individual basis.
Uh-huh.
Yes, that's helpful.
This is something that takes a bit of getting used to. Of course, you're not populating the report yourself, so there's an additional level of understanding that happens when you're actually putting these numbers in the spreadsheet yourself and reading through the report itself and not just looking at the results. And then it gives you a very good sense of how things are moving on a month-to-month basis. So this month, we've gotten a few confirmation signals. So if you remember, last week we said we need to watch out for the food, beverage, and tobacco products to see whether this almost kind of inflection point in September, whether that will be continued further in October. I think we are seeing confirmation signals. I'll also show you another confirmation signal just now. So that bodes well for this particular segment. And this is literally how you have to be interpreting the ISM report on a month-to-month basis. You cannot just look at it in isolation for 1 month and then start generating ideas. You need to be seeing evolution of these very early trends and then give you a bit of confirmation signal, because that's going to form the conviction that you need to be able to find the right trade ideas. We're also seeing confirmation of many bearish themes that we had identified. So particularly in the printing and related support activities and paper products. So another highly contractionary month. Has anyone looked at what happened to Simpress? Anyone? No. So Simpress was down significantly. I think it was probably like 15% and above. And on earnings day, it was even more. So, it's not a company that's unknown to you. You would have heard me speak about it a couple of times on the presentations and in the Discord server. And then we have a stock that just sells off on earnings day. So it's not magic, or it's not like I have a crystal ball. I'm literally showing you my thought process behind finding these ideas. And, it's like the gap between what I know and what you guys now know in terms of, what's out there, what exists, what types of reports are there, and how predictive is one report versus the other. That gap is closing quite significantly, which also means that you should be able to identify a lot of these candidates. Of course, I don't expect you to be able to get from start to finish in a spectacular manner. I still expect you to, find a bit of difficulties here and there, struggle, ask for a lot of questions. But that's typical of the learning path. And I think you should all be, like I told you, right? You need to be, after you've realized this, you need to be able to, you need to be sitting differently. You need to be walking differently, because it's literally life-changing, right? If you know that on a monthly basis you have a report that gives you such predictive value and increases the odds of you finding great long and short ideas very consistently. Another trend that we identified last month was the computer and electronic products. So we've got another confirmation signal that things are expanding within that space. I've also identified a few other segments. I think two more that I want to speak about are the chemical products. So I want to speak about chemical products because chemical products are mostly the feedstock for other industrial processes. So if chemical products are struggling, chemical products themselves are a leading indicator for many of these other industries that you're seeing. As an example, let's say one example of a chemical product would be adhesives or lubricants or sealants, or let's say titanium dioxide. All these things, all these specialty chemicals are used in other industrial processes. So if chemical products are struggling, and it's been happening for the last 3 months, what does that mean? It means that we should not be overly bullish on industrials. So if you go down the value chain, that weakness that we're seeing in the chemicals products segment is likely to follow through over the next couple of months into the industrial sector. And we are seeing it in Europe already. We're starting to see it in the US as well. So it's setting the stage for you to go and find ideal candidates that have a lot more weakness, and that investors are probably not following that closely, and these companies could have significant downside potential from here. And then lastly, transportation equipment. Again, this is something we've been covering for months now, the auto sector it's not just the auto sector. It's got more to do than autos. It's also coming from this theme that because of all the uncertainty from the results of the elections and uncertainty related to monetary policy from the Fed, a lot of companies have been holding back on large capital investment projects. So of course that's got demand for a lot of these companies that produce these durable goods. And if you're not getting a lot of demand for, let's say, things like tractors or commercial fleet vehicles, machinery and so on, it's likely to hit the value chain, right? So that's literally what we are seeing. It's all. I think you would be quite excited to see how things are almost like moving in line, as if you're watching a movie in real time, right? Moving on, I wanted to spend a couple of seconds on this commentary. This is an important statement. The share of manufacturing sector GDP registering a PMI calculation at or below 45. 45 is highly contractionary. So if you're going below that, that doesn't bode well for the future of GDP. So that came in at 46% in October. So in September, we had 41%. And then in October, it's 46%. So the share of manufacturing industries that are highly contributive to GDP, that's coming at highly contractionary, or coming into the highly contractionary territory, has increased by 5 percentage points. And when I'm actually populating these reports, these Excel sheets, when it comes to sectors or industries that have been in expansion, it's probably 2, 3, 4. When it comes to manufacturing industries that have been in contraction, it's like 10, 11, 12. So that in itself is giving you a lot of indication of all the flux that's happening within the sector. Another part of the report that's quite important, it's the commentary section by purchasing managers from each respective industry. So you can read this on your own. I've highlighted a few that I think are interesting, and it's also tying in with the things that we've been following. So one thing that was quite interesting to see was now investment in commercial vehicles is also being halted. And that's in line with this whole delay or stopping of large capital investments. And then if we look at, let's say, the machinery segment, that's also following through. A lot of customers are almost like running their projects for too long and not reordering inventories or machinery or anything like that. It's a little bit of a wait and see approach. It's like people want to climb over the wall of worry, get on the other side, and then have a better view on the future before they start expanding their capital, the capex budgets. I think it's interesting to read that the month of October has been very positive for food, beverage, and tobacco products, and that's projected to continue into the year end. So that's in line with the commentary that we've been getting from this industry in the past. So, of course, this would be a fertile ground to be looking for long ideas there. And then finally, when we look at wood products, they seem to think that consumer confidence in building materials remains relatively strong, and they expect that 2025 will be better as we get lower interest rates, and that probably will stimulate demand a bit more for housing or for home repair and improvement products. I don't necessarily think so. I think we'll need a lot more in terms of rate cuts before we get that segment restarted. But it's important to have a diversity of opinions as well, and to understand what the consensus is thinking, and then form your own view on that basis. So with all of that out of the way, let's get to the interesting parts now. So the way you need to be thinking about markets, so we've got November and December left. A lot of companies have already reported, quite a few left to report yet. Also, December tends to be a relatively low trading volume month because people go on holidays and so on. We have a number of bank holidays towards the end of the year, with Christmas, Boxing Day, New Year, and so on. So people tend to take the last 2 weeks off, and if you're expecting something spectacular to happen within that period, it's unlikely. So if you're structuring your ideas in such a way that they happen in the last 2 weeks of December, I'd be a bit careful there, because the trading volume is not there to let your idea work out. It's better to start thinking about things from a January, February perspective. A lot of companies would have reported their fourth quarter, so the full year is over for them. What that means is investors would not necessarily focus much on in terms of what's gonna. Oh, sorry, I wanted to say a lot of companies have reported 3 quarters, and there's probably 1 more quarter left for their full financial year to be fully reported. So investors will be in a mood of, we don't really care about Q4. What we care about now is the next year. Give us guidance for 2025. Let us know what are your plans for 2025. And the share price will also start almost pricing in all these new found expectations. So in many cases, you might see companies report Q4 and then earnings move in a totally different direction, because people are more focused on guidance as opposed to what's actually happening in Q4 itself. Of course, if it's meaningful, then the share price will move according to that too. But what I'm trying to say here is, don't overplay the last quarter. Just understand how the market thinks and what they are focused on. It's predominantly going to be guidance for the next year. And that's what's going to move the marginal buyers and sellers of stocks. So with that in mind, we need to do a lot of work going into 2025 to identify high quality long trade ideas as well as high quality short trade ideas. So the benefit of going into 2025 with a watch list that's full of ideas is that you know that you'll be playing a lot of these ideas over a 6 to 12 to 18 to even a 24-month on a 24-month basis. I'll give you one example. The idea for CarMax, you probably had seen a video from me 1 year ago on CarMax. Not much has changed in the thesis. So I'm still playing that idea. Of course, I'm refreshing my thesis with upcoming information and also looking at the stock price to see whether, there's an opportunity to trade it up or down. And what I'm trying to say is, one piece of research that was done, let's say, in August 2023 is still very much helping me to find ideas and to be able to trade one step ahead of the market. So that's the benefit of going into 2025, having done a lot of work and having all these ideas that are primed to move a lot in 2025. Also, from a market perspective, understand that participants come back in January and it's almost like the dial is reset for them. So their bonuses would have been paid out, and now the bonus for 2025 will depend on what happens from January to December 2025. So in January, expect them to be hunting for ideas that have a lot of upside, and they'll be seeking risk quite aggressively. So keep that in mind, because as traders, we need to know about these not necessarily always fundamental factors of the market. It's more to do with the market infrastructure and how the market is set up, and what's actually driving capital flows within different sectors, different industries. In terms of long themes, I think, as I've discussed, I think there are still a lot of high quality ideas in both the small and mid cap space that are primed to move. It's your job to go look for them and play them. There are so many ideas, and I'm not going to be spoon feeding people. I think so far I've been a bit more on the spoon feeding side and, pointing people in directions and so on. I'll be doing less of that, hopefully. Another theme that I think will also be in focus would be capital rotation from these growth or large cap, mega cap segments to value segments. So finding low PE stocks where, let's say, you have a new strategic plan to transform the business, and that can take the form of to reduce cyclicality of the business, reduce its debt, increase its margins, improve quality of cash flows. As an example, turn the business from a one-time revenue type of business to more of a recurring type business, a little bit like software. The market will give more credit for these types of businesses because they have visibility on the future revenues, and these tend to be higher quality cash flows as well. Another factor that I'll spend a bit of time in the next few weeks to discuss would be increasing free cash flow yields. So I think in the Discord server, I discussed the free cash flow for a company called Ball Corporation. And that theme of free cash flow generation itself is very important because if you remember my analogy, right, where you have a water tank and then you have water coming in and water going out of the water tank, right? So water coming in is basically money coming into the business, water coming out are expenses and so on. At the end of the quarter, you basically want the water level to keep going up, right? And that's literally free cash flow generation. The higher the water level in the tank, the more levers management has to pull, whether it's in terms of returning capital to shareholders as dividends, buybacks, issuing special dividends, and so on, doing mergers, so buying competitors to increase their own market shares, or whether it's to reduce debt, or even to reinvest in the business. So as traders, as we are looking at short-term time frames of 4 to 10 weeks, let's say, we don't always see the free cash flow generation impacting the company, right? That's more for long-term investors who, let's say, take a view for 3 to 5 years. They can clearly see how the free cash flow generated in 1 year is leading to this business becoming more high quality by reducing debt, reinvesting in themselves, paying higher dividends, and so on. But we have to recognize that although we have a shorter time frame, the stock moves that will happen will predominantly be from institutional buying, right? If we're looking for long ideas. And the institutional buyers will start to pay a lot more attention on these fundamental factors now. We've already had the early part of the bull market where a lot of stocks move by virtue of momentum, and there's a lot of benefit of doubt given to a lot of companies. Now we're getting into a bit more of a mature segment of the bull market where investors will be a lot more demanding when it comes to fundamentals. They'll be a lot more demanding when it comes to, this is what you said and this is where the business is at. So show me, what else is available within that business. Why is it that I should commit capital to buying this particular company or not? And in that environment, you have to also shift your idea generation a little bit to kind of understand what the institutional buyers of stock will be thinking about and focus on companies that are actually improving these metrics, because these companies will actually go up by a lot. I'll give you one example, a very clear example, Proto Labs. I think I discussed it around July with you. So I've been looking at it from May, and then we discussed it in July. So on Friday, it rallied by 38% after earnings. And that was on improving fundamentals and more proof from management that their transformational plan is actually being executed well. And the market is giving a lot of credit to these type of ideas. This week we'll have Trimble, TRMB, that will be reporting. I think that's another similar candidate for a PE expansion or re-rating upwards type of situation. So keep an eye on these ideas, but most importantly, find your own, understand what's the makeup of these ideas, and then go in the list of stocks that are trading and try to identify candidates that have these same types of characteristics. This is not very difficult once you've understood the backdrop and also once you've got a clear bias in terms of which sectors or industries to be long and short. And finally, I think turnaround stories will be back in focus as we get more long-term investors who start looking for the next leg of growth in an environment where stocks are probably a bit too richly valued and GDP is slowing down. So as I've said, investors will become a lot more demanding now in terms of fundamentals. And that bodes well for us because, we understand how to find all these different types of ideas. For those who are not familiar, you can look at my video on Tronox Holdings. I think that was a masterclass in how to look for turnaround stories, how to vet them, how to assess them, and how to make sure that your timing is well, that all the stars are aligning for that idea to work. So essentially what we'll be looking for is those ideas that are moving from a bear market to a nascent bull market within an industry. So like I always joke about, is you make the most amount of money when a company goes from absolutely crap to still crap, but not so crap. I think you understand what I mean, right? So that part of the cycle when sentiment changes and that's on the basis of fundamentals improving, that's a very powerful stock price move that can happen there. And if you are long these types of stock and you structure these ideas well within your portfolio, it's very easy to be making a lot of money, but also to be playing them a couple of times during the year. I think that's the most powerful thing about being one step ahead of the market with your thesis. If you're not prepared, then you have no chance. You'll be on the back foot. You'll always be chasing ideas, as opposed to what you should be doing is basically be prepared with your thesis, wait for your opportunity, get positioned, and then just get your rewards along the way. Get out of the trade and then wait for it to give you another opportunity. If that's in a month's time, 2 months' time, whatever, then play it again and then just, make very high risk-adjusted returns on that basis. It's a very small shift, right? It's all about being prepared, all about being one step ahead of the market. When it comes to short themes, so a few things that I think you would have seen me talk a bit about it in the Discord server. So there are quite a few high PE stocks where, growth within the company itself is faltering. And I think investors are about to challenge the high PE multiples. So investors becoming more demanding or even fickle means that they're not just going to be paying all sorts of high multiples for any type of companies. They'll be re-underwriting a lot of ideas and making sure that they are not overpaying for these companies. So companies like Floor & Decor, as an example, it's growing at like 0.1% or something from a revenue perspective. Earnings are coming down and it's trading at 50 times forward PE. I don't think the market will be very kind to these kind of ideas. And if we get positioned as shorts, I think there's a lot of opportunity out there. You have these in the tech software space. Another example that we had this week was Wingstop. We discussed it last week. And I said I was not seeing all the signs aligning for shorting it. But even then, it sold off like 25% post earnings, and that was predominantly because it was priced for perfection, and then it announced growth numbers that were not to the market's taste, and it's literally the scenario we discussed. But I just didn't have enough conviction at that point to be positioning as a short. So these ideas are out there. They're happening week in, week out. That's my whole point. I'm not here to lament on things that have happened and we probably haven't participated, but I'm here to give you a sense of what the market is doing under the hood, and to just take all the noise out from the market and point you in these directions, because they always say, right, success leaves clues, and it's the same in the market. The market is telling you what type of trades are working, and it's your job to go find them out, position for them, and then just make great returns on that basis. Another theme on the short side that I think can work, so stocks which have fared well despite weakening fundamentals. So there are a lot of companies where maybe revenue growth and EPS have gone nowhere in the last year or so, but the share price has not necessarily corrected. So investors haven't necessarily punished the company for that. Investors have been more in a wait and see approach, and giving a lot of benefit of doubt to these companies that, maybe they're undergoing a couple of weak quarters, and growth is about to come in 2, 3, 4 quarters. But now I think a lot of these companies will be questioned, and it's to do with investors just moving into a different type of mind frame, where they want to eke out all types of returns that's possible with these companies, and they know that a lot of these companies are probably overvalued from their perspective, and they will not be buying these companies until they are significantly lower. As an example, this company Arrow, I think it was presented by one of our Discord member, Amin. So he thought this would be a good long, even wrote a relatively good trade idea thesis and shared it with the group. But the market market essentially just said, look, it's another quarter of you not delivering. And then the stock was down massive on earnings day. So, this is going to happen over and over again, because there are many companies like this where investors will just run out of patience, and there's a bit of fatigue that's been developing from long-term investors, seeing these revenue and EPS numbers not necessarily moving in the right direction. I wanted to discuss something else with you, but before that, do we have any questions on the presentation so far?
Oh, awesome. Okay, it didn't work earlier. Just one query here, Roshan. A lot of the fundamental, the crux of what we've been discussing for the past couple of months is oriented around short-term movements and short-term trading. Is it always the case that short-term trading is better than long-term trading, and these ideas we discuss, are they in any way applicable to long-term share investment as opposed to short-term derivative investment?
Absolutely. So what I'm discussing here, it's what I believe to be the sweet spot, right? As a trader, right? But of course, as you see, a lot of the discussions are fundamentally biased, right? And even as a short-term trader, I tend to play a lot of these ideas multiple times across, let's say, a 6 to 12 month horizon. The only thing that I'm doing differently from, let's say, a long-term participant is I'm not always having that risk in my portfolio for like 12 months or 36 months or 60 months, right? So I'm picking my slices of where I believe the volatility might come into the stock and I might have a relatively good return to make. And then, of course, I'm structuring the idea using options to magnify my returns. A lot of what I'm doing here is what you'd call, it's based on actionable catalysts that have a predefined date, like earnings or competitor reports and so on. And the reason I mention this as the sweet spot is because if you pull up any stock chart, you'll see that there's a lot of weeks or even months where the stock does nothing. It's moving sideways, and from my perspective, there's no point for you to have the risk on at that point in time. But of course, you can never tell, when things are going to move and when they're going to trade sideways. So long-term investors say, look, I'm going to buy 5% of my portfolio in this stock and I keep it for 3 years. I think it can triple, get to 5 times and whatever. But now it's a question that's more related to you, right? What's your lifestyle like? What's your personality like, right? The idea itself holds merit in the short term and in the long term too, right? And if you believe that because of work priorities, because of your, as an example, right? Maybe you're not someone who can think on a 4-week time frame. You want things to be a bit more, on a longer time frame. Then you can certainly skew the approach, right? You can certainly buy stock, for example, for 3 months, 6 months, 1 year, 2 years. And the benefit of using this approach is that you're likely to be timing these ideas very well compared to how long-term investors look at things, right? Long-term investors will buy something at 100 and they'll keep buying until it gets to 90, 80. And it's probably after 3 months or 6 months that the idea will start to work and they'll break even on the idea. And then eventually in 5 years' time, they'll make 2, 3, 4 times their money. If you take this approach, that's a lot more tactical. You get to have a long-term view on the company from a fundamental perspective. But then you would also be saying to yourself, oh, but wait, why should I put the position on now, right? From a timing perspective, are things aligned? Are all the planets aligned for me to pull the trigger now? Because if the stock is going to go from 100 to 80, why do I not buy it at 80? Fundamentally, maybe the picture would be similar, but 80 is a much better entry price for me as a long-term investor. So the skill set that you develop here is certainly something that you can adapt to other time frames too, because it's highly fundamentally based, right? Even if you're trading derivatives, you can still take a bit of a longer term approach. There are ways to play an idea over a 3 month, 6 month, or even a 1 year basis. And they are also very clever ways to, to be structuring these ideas in the market. And it will also not feel like it's a very active method because you're basically going to be doing 1 or 2 executions per month as you're just readjusting your portfolios and just seeing whether the market agrees with your idea or not. And the beauty of playing it with derivatives is in many cases, so the first benefit of trading options is that your losses are always limited and known upfront, right? So if you find an idea like Proto Labs, for example, right? Let's say I've identified it in July, it's trading at 28 or something. But I recognize it's not going to move in, let's say, on a monthly basis. It's probably going to need 6 months or even a year. What I could do is I buy call options that have expiry in 1 year. They will be available. You will still find them. And then right there, let's say I have $10,000 allocated to this trade, right? I know the maximum loss I can make if I'm wrong on the idea is 10,000. That's the biggest advantage of trading options. You know right there and then that if the idea doesn't work, the maximum loss is 10,000. Now, there are other strategies that you could implement in the market whereby you reduce that, what we call the net cost of the trade over several months by shorting call options. So the whole idea is that over the whole duration of the trade, you're still long volatility on the stock, but in these moments of inactivity or when the market is not agreeing with you, you're taking advantage of that volatility and you're basically reducing your net cost from $10,000 to maybe $8,000 to $5,000 and so on. And the whole thing is that by the time you get to, let's say, the last few months of the trade, it's possible that if you've done it correctly, it's possible that you no longer even have any net cost for the trade. So you're riding a free trade. If it works, you make $50,000, $100,000. If it doesn't, you lose nothing because you've already reduced your net cost to zero. So these are very advanced option trading strategies. But all of that makes no sense until you've got your trade idea generation process, firmed up and, really well done. There's nothing that will save you if your trade ideas are not good. Risk management, nothing will save you. You can be the most clever guy out there. You can be the best risk managers. If your trade ideas suck, you will eventually die. It's literally like, okay, if your trade ideas suck and you're a very good risk manager, so instead of losing in 2 years' time, you'll maybe extend that for 1 year, but you'll eventually die. Right? Does that answer your question?
Yes, and more. Thank you very much.
Yeah. So I think it's a very important skill to develop, Haider, because then it gives you choice, right? You could say, okay, I want to be a long-term investor, but now I'm also equipped with the skills of a short-term trader, which means that this will give me a great advantage in terms of my timing. And also, along the whole duration of your trade, if let's say the stock pulls back, because you have the skills of a short-term trader, you know how to think about it. You know whether to cut the position or whether to increase your position, because short-term traders are looking at it very differently from long-term investors. And since you're playing it on a much longer time frame, you still think that your thesis is valid. This is something called as time frame arbitrage, because the guys who have shorter time frames and the guys who have longer time frames don't necessarily look at the risk in the same way. And it's literally a statement where you're saying, I'm purposefully choosing this approach because I want to be a beneficiary of, let's say, something called the time frame arbitrage. From my perspective, it just gives you a lot more choices to make. Okay, so I wanted to speak to you about this. When you talk about assets, right? Predominantly financial assets. So you have like what I call a risk asset spectrum, moving from the most speculative to the least speculative risk-free assets, right? So I've got a few examples here. So if we're looking at the most speculative segment, this would tend to be like nano caps, micro caps, small cap equities, crypto assets. And then slightly more speculative would be mid cap, large caps, mega cap equities, commodities, currencies. Then even less speculative might be fixed income. So government bonds, municipal bonds, and corporate bonds, although they are still a bit more speculative than government bonds. And then in the risk-free assets, you have US bonds, right? So you would have heard me speak of risk on and risk off sentiment, right? This is literally what I mean by this. When you have risk off sentiment, capital will tend to gravitate more towards the risk-free assets. So it doesn't mean that everything goes to the far right end. It just means that capital will be pulled more towards the right end. So capital will move from, let's say, equities into fixed income, into US bonds, or capital would move from, let's say, small cap into large caps. The flux would be more towards the right. And when we talk of risk on behavior, it's going to be the opposite, right? And this is, I think, a good illustration, and I wanted to show this to you just so you understand what exactly risk on and risk off sentiment mean. So in this slide, I've gone a little bit more in details, and this is predominantly equities, right? We've still got this risk asset spectrum, and I've taken out currencies, commodities, bonds, fixed income, and so on. So we're focusing purely on the equity section. The most speculative end consists of companies that are pre-revenue. So these would be companies that are doing a lot of research, like pharmaceutical companies. They haven't yet got a drug that they are commercializing, but they are still working at lab scale and, you know, spending a lot of dollars on R&D. And by virtue of that, revenue is zero. They have elevated cost in terms of R&D. These companies will not be making profits, right? But they still trade. They will still move up and down. And because they are not yet like a proper business that's predictable, that has predictable cash flows, they are part of the most speculative risk assets. You also have junior oil and mineral exploration companies. So these would be companies that are not yet producing oil or any type of minerals. They're still digging in the ground and trying to find a deposit, quantify the quality and the scale of the deposit. And these would still be trading on the market. And they would literally be printing negative earnings every single quarter because they have no revenue. And all they're doing is basically using the capital to drill in the ground and find either oil or minerals like gold and silver and so on, right? And then within this segment, you also have highly leveraged cash pool companies. So these would be companies like, let's say, Avis, where there's a lot of debt, the business is not doing well, it could go bankrupt in a couple of months. There are companies where you need a high reliance on product adoption. It could be a company where it only has one or two products and it's still being traded or sold on a total addressable market type of concept. So we haven't yet established whether there is a need or a demand for their products. And basically what management is selling is literally just a concept. It probably could even be before the proof of concept stage for the company. So you have a lot of companies within that space. We saw a lot of these companies in 2020 during the COVID era that were coming to the market, and they were rallying quite a bit. And these companies did not necessarily have much to offer in terms of actual products. But investors were just, they had the risk on hat on, and they were just buying all of these speculative vehicles or companies. And then you have companies that are nearing or emerging from bankruptcy. As you move to the slightly less speculative segment, you would have highly cyclical companies. We've seen quite a few of them. Companies with high revenue exposure to certain clients. So if you have, let's say, 30 to 50% of your revenue assigned to one or two clients, that's a bit of a risk, because if they decide to no longer order from you, you're kind of screwed. Companies with weak balance sheet, refinancing risks, and so on. And then you have companies where there is a high risk of obsolescence. So basically, they are selling a particular product that could go out of fashion in a couple of years or even shorter than that. We've seen quite a few of these in the hardware space, especially amongst computer hardware. You see this happening a lot. And if they are not innovating, if they don't have high R&D budgets to keep product innovation on, these companies can go from hero to zero very quickly. So from that perspective, they are still highly speculative. And then you have the more or the less speculative types of businesses. These would be large cap, stable businesses with large market share. One example could be Apple, Microsoft. So in the next few years, they're still going to be around. They won't be bankrupt. There might be significant changes to their business models, but they won't be struggling for their lives, right? They have a large established market, and they'll still be, making revenue and profits from these established client bases. We would also have companies that have high pricing power, and they have competitive advantages within their industries. So you can think of many examples here, right? Apple is one of them. They have pricing power. They have like a whole world of people who are willing to pay anything for their products, even if the only difference is probably the model number. So that's an example of pricing power. It's also an example of competitive advantage. It's the concept of moat that I think Warren Buffett talks a lot about. So this gives a bit of security to the business, and by extension to investors in the business. You have companies that have healthy levels of operational cash flow that can finance their own growth. So that's why I think it's important to start looking at the free cash flow generation ability of businesses, because if you can generate your own free cash flow in a very healthy manner, then you don't need to take more debt to finance your growth. You can still do that, but you can use your free cash flow that's generating more cash for the business to finance your own growth into the future. And lastly, you would have companies that have high cash balances, low leverage, so they have a lot of room to maneuver in a downturn. And these companies would tend to be acquirers of smaller companies in their industries if you have a downturn. So they would do this to be able to increase their market share, or to be able to change their strategic approach to the market. So the company can buy its competitors on both a horizon. So if it buys one of its competitor, it's going to be increasing market share within the same industry base. But it can also do what's called vertical acquisitions. So basically, it starts buying companies along the value chain, and this will allow the company to start getting exposure to other parts of the value chain, which means that this can be significant revenue generator, but it can also help the company to take a very different strategic approach to the way it runs its business. In some cases, it can also allow the company to restructure its cost base. So let's take an example. If you have a company that, like Amazon, for example, initially it was just an online reseller or an online retailer. And then eventually it realized that it's spending quite a bit of money on cloud services, on hardware and all of these. and it realized that, it could just do all of these things in-house and get into a slightly different vertical, and by virtue of that achieve cost efficiencies that none of the others would be able to, because it's invested a lot, not just in terms of funds, but also in terms of the skills and developing its infrastructure to have a well-functioning cloud server that it's using to be able to run its own business. And then eventually it managed to create another business out of this by making that cloud server available to the public, where the public would pay it to have the privilege to use their cloud services. So that's how a company moves from being predominantly just a website selling stuff to getting into other verticals that gives them advantages that they would not have if they were just focusing narrowly on the industry. And then finally, you have the defensive sector. So these would be utilities, consumer staples, and healthcare stocks. So what I wanted to achieve with these two slides was to illustrate to you what it means to go from risk on to risk off. And I've got this slide, which is predominantly for the equities section. And whenever you're structuring your portfolio, you need to be thinking of movement of capital from one to the other, either left to right or right to left. And that would constitute the ideas that you would be putting in your portfolio. I'll pause here for any questions that you might have. I think I have a last slide, and then we can open up for a wider discussion. Do we have any other questions on these two slides? Any questions?
Nothing. I think it's a lot of information. Probably we'll have to think about it a bit.
Yeah, of course. And then finally, right. So this is essentially what you're trying to achieve as a portfolio manager, right? You want to have a diversified portfolio of long and short trades. So you could ask me what shape does that take? I've got one example here, and it doesn't mean that this is how your portfolio needs to look all the time. So your portfolio needs to have a specific type of bias. What I mean by bias is, are you net long or net short the market? Do you think the market will go up on average, or do you think the market will go down on average? Being neutral is also an option. So you can set up your portfolio to have varying levels of biases, but at all times you still need to have long and short trades, because over our time frames we never know whether the market will go up or down, right? We cannot tell what the S&P will do. We can only tell what, for example, a particular company might do over the time frame of our trades. So with that in mind, we have to build a portfolio where, let's say, if cyclical stocks are in favor, we benefit in one way or the other. But also if, let's say, we should not be positioned heavily with only cyclical stocks, because then we are making a one-sided bet. We're saying either cyclicals are in favor or the whole portfolio is down. And that's definitely not diversification of portfolio, right? So in this example that I've got, on the long side, I've got low PE value type stock. Obviously, I want to have a little bit more of a catalyst within, where maybe the business is transforming a little bit. Like a Proto Lab would be an amazing example. Then I can have another idea in a consumer discretionary segment. So basically, if oil is going down, it means that consumers will have a higher level of disposable income. which could benefit consumer discretionary stocks. So I'll be long one stock within that segment where I believe there's a lot of upside. Could also be long one tech software stock with the right type of fundamentals. I can find one turnaround stock and have a long trade there. And then I can find one defensive stock within, let's say, healthcare or utilities segment. Then on the short trade side, as we've discussed, I can find one high PE stock where I think growth is slowing down and the PE will come under pressure. To hedge my long consumer discretionary stock, I can have one short consumer discretionary stock. And then similar, to hedge my long tech software stock exposure, I can have one short idea within that same space where, let's say, growth is coming down. I can have one idea which is a short large cap where I think the company is at the risk of a capital rotation out of large cap plus out of its own sector or industry. So that could constitute another form of short trade. And then finally, I can be short another defensive stock. So even if I'm long one defensive stock, it doesn't mean I cannot be short a defensive stock. Within the defensive stock, within the defensive space, we see both, companies that do very well on the long side and also companies that do very well on the short side. So one example was this company HSY, which is Hershey. In 2023, it was rallying quite significantly. And that's predominantly because everyone was positioned defensively. So the valuations just got to, very elevated levels. I think the forward PE was something like 46 for a consumer staples company, where revenue growth is like 3-5% and earnings growth is nothing extraordinary. So this is what I call a hedge fund hotel. So all these guys, they get positioned defensively and they just keep buying the stock without necessarily doing the right fundamental work on it. And then eventually it goes to lofty valuations. And as they all exit, the share price comes down quite significantly. So if you pull up a share price chart for Hershey, you'll see it peaked in, I think, May 2023, and then it went down almost 50%. And, if you have such type of trades in your portfolio, you're not only just diversifying risk in your portfolio, you're also making significant returns. And then finally, you would have a couple of trades as market hedges. So that would depend on your net bias on the portfolio. So you might want to have long or short emerging markets, depending on what's your view of, macroeconomics and where capital is going to flow next. You can have long or short IWM or any other ETFs, right? And that's predominantly based on your view and also based on the bias you're trying to achieve within your portfolio. You can be long or short NASDAQ, long or short the TLT, which is it's an ETF for long-term bonds in the US. So that's essentially how a diversified portfolio should look like. And the most important thing to note is that when you have a live portfolio which have this type of diversity, you don't expect every single idea to work. Because by definition, if these ideas were to all work at the same time, it's not a diversified portfolio. So the approach we are taking is we have these ideas for different types of scenarios. And then only one or two scenarios will play out. And within these one or two scenarios playing out, a few of these ideas will be large winners. Some will not work, and others maybe will be able to exit at minimal losses. But what I'm trying to get to you here is that losses are just part of the game. And the reason you're making losses here is not because you suck as a stock picker. It's deliberate. You're picking risk that is non-correlated and sometimes even negatively correlated to other things in your portfolio. And by definition, if one side of the book works, the other side must not be working that well, because by default, the correlations were either 0 or negative, right? So I'll end here and I'll open the floor for any questions that you might have.
Roshan, one further question here is, so when we look at the ideas we've discussed so far, they're quite based on, they're quite data driven, and I'm trying to speculate. But on the issue of things like social responsibility of the company, for example, we mentioned tobacco came up in one of the earlier discussions we had. If any of us wanted to, for personal issues, wanted to avoid investing in those types of businesses, but wanted to invest in things a bit more, I don't know what the right word is, but socially responsible, if that's the right term to use.
Yeah, I mean, look,
what would be the approach
what
there?
you're alluding to is if your personal beliefs don't align with a particular company from a morality perspective, it could be tobacco, it could be alcohol, it could be companies that manufacture weapons, companies that maybe you don't think operate morally. Like in my case, I could even say I don't like junk food because it's making the whole world sick, and I absolutely despise anyone who gets involved in this space. I can choose to never be a long-term investor or even trade any of these stocks. That's not a problem. It's a personal decision that you make.
Thank you.
Because see, what I'm trying to also get to the team is, once you have this skill, right, this skill set, right, the world is literally yours. You're spoiled for choices, and it's for you to decide what to do with this skill. You could sleep on it, do nothing. You could do a lot with it, and then let's say you find 20 ideas, and then you're like, oh, but 5 of them don't align with my personal convictions, my personal beliefs, and I consider them to be morally corrupt. Then you just put them aside. It's not going to impact your returns, your portfolio. You're not living in a world where you're confined or limited in any way, because you want to still approach the world with a moral compass. If anything, it's giving you a lot more opportunities to sift through and never make you feel like you have to participate. And that's a very powerful thing in my view.
Thanks very much, as always.
You're absolutely welcome. Like I'll give you an example. I knew very well that a lot of these companies that manufacture weapons in the US, weapons or aerospace and all of this thing, I knew very well they'd be up 50, 100%. But it doesn't align with my moral compass, right? I will never trade them just to make stats look good on my portfolio. It's beyond the point, you know?
Thank you.
Any other questions?
Yeah. Hey, hi, Roshan.
Hey, how's it going?
Good, good, good. Hey, I have a question for you. Can you give me a broad analysis of your of an earnings season so far? What have you seen, and is it aligning with the ISM report? Because we've seen contraction for the past 2 months, right? So
Yep.
just wanted to see your opinion here.
We haven't had many companies reporting yet, right? We've had a few. And within what I've seen, like I think FedEx was a big one, which did indicate that there is a lot of slowdown in the goods economy. we are seeing this with the ISM in one way or the other, right? Because manufacturing industries essentially will be either moving raw materials or moving finished products, and FedEx would be involved in one way or the other. So we are seeing it from that perspective. Also digging down in the transportation stocks, we've seen, I don't know if you've covered one or two, but we were looking at a couple of them, the large ones. It's not coming to my mind now. Knight Swift and a few others that are more like multi-line multi-line trucking companies. But what I mean by multi-line is they are involved in segments that, let's say, get the containers from the ships, which basically is called upstream. And then they also involve in the downstream segment, which is basically delivering containers or finished goods to the end users. So these companies are also not growing a lot. They, it's getting very nervous in that space. So from that perspective, you're seeing what we've seen as contraction in the ISM play out. Within the industrial space, I haven't done much work at a company level to see exactly whether things from the ISM are being mirrored there. I would not doubt that it's being mirrored. The counter trend to the ISM is basically this bring back manufacturing to the US theme. So within, let's say, commercial construction as an example, it's been doing very well for that reason, because people need more warehouses, people need more industrial space, right? Even if residential construction has been disappointing, the commercial segment of construction has been doing very well, and that's the counter trend, right? So the ISM itself is not going to give you that level of breakdown or perspective. So you will have to know about what's happening in other parts of the market, both in the private sector, public sector, and then mirror that with what you're seeing in the ISM. So the ISM is there to point you in the right direction. It's kind of giving you clues as to where the wind is blowing, but it's not the holy grail in itself, right? I think I also mentioned that for almost 2 years, it was almost pointless to look at the ISM report because it was not being reflected in stock prices, because other things were driving the share prices at that point in time. And I think now what's happened is we've passed that abnormal phase following COVID, where the business cycle and every industry cycle has kind of been, I don't want to say manipulated, but almost like distorted, and it's not necessarily performed as per historical trends or on a historical, as per what normally transpires on a historical basis. And now we are moving more towards a normalization of these cycles. So a lot of share prices are still looking at what's happened in the recent past, not taking into account that eventually these long-term trends, they are still well in place. And as you have normalization of these mini cycles, the long-term trends just take over, and within a couple of quarters, you'll see meaningful revisions in the numbers. The auto sector is a very good example. If you just keep extrapolating last quarter onto the next quarter, I think that's a bit of a dangerous approach to take.
Right. And just to follow up to that, you said the ISM report was not useful at all over the last 2 years, but overall, ISM report is kind of the starting point, right, for trade idea generation. Not all of them.
It's a starting point.
Not all of them.
It's a starting point for trade ideas that come from the ISM.
Yes, correct.
Mm-hmm.
And so for velocity, how did you navigate for that section,
So,
especially?
look, I have almost like 6, 7, 8 types of ways to generate trade ideas. ISM is one of them. At the end of the day, the ISM is giving you a shortcut in terms of where to look, right? It's giving you that direction of the wind. But if you're looking at individual stocks within an industry or narrowly focus on a particular industry, you will get that information anyway, right? So if ISM is not giving it to you, and other things might be driving the market at the time, then you will have to look at other, in other places for your trade idea generation. But by and large, the trade ideas come through from individual stock analysis, looking at competitor reports. So let's say there's a company that reports today. I'll look through it and I'll be like, okay, that's interesting. What's happening to other companies within its industry? And then I'll realize,
Or even up chain or down chain, right?
yeah, exactly. So basically, you look at a random report and then you're like, oh, actually this industry is booming, but what other companies could benefit from this move? And then some of them can also be thematic. As an example, if we have the bring back manufacturing to the US, who are going to be the winners? If you have an electrification theme going on, who are going to be the winners? If you have an AI theme going on, who are going to be the winners? And within these themes, you can find tens of ideas because it's a very wide, exposure. You have hardware, software, you have many companies involved which will be impacted. Same thing for EVs, for example. If you have a move towards EVs, there's a whole panoply of companies that would be benefiting. So that's another way to generate ideas. I think also sometimes you have, let's say, macro events happening. Inflation, you have, what's that? You want to find companies with pricing power. You want to find companies that don't have pricing power. You want to find companies where inflation will affect them disproportionately. You want to find companies that will be affected, let's say, by freight costs rising, or the other way around. Sometimes I will look at other industries where there is a fundamental shift happening in terms of supply and demand. That could be shipping, that could be oil and gas. So you can see, right, these are very different ways of looking at the market, nothing to do with the ISM per se. Some of the ideas can also be based on macro factors like interest rates. So you'd go hunting for companies that need to refinance, and on that basis they would not be able to find cheaper finance, which means that's negative for the equity, and so on and so forth. So the more you do, the more you will learn about these things. It's like a very intricate web. And the more you do, the more you'll be able to crisscross and, eventually get to the bottom of things. Okay, one final question. Hans, you've been very quiet.
Yeah, I've just been thinking about, from ISM, it looks like paper is going down over last two. Started looking at it, I found silver.
Yeah, we discussed it, yeah.
Yes, I started reading about it. Like, I don't know, like, I'm not sure if I'm missing something because from my research so far, it doesn't look like the company is doing well, but from the price action,
it keeps rallying, right?
Yes, it just keeps rallying.
And
I'm just wondering whether there's anything, any report or anything that you'd advise for it, or
not specifically. I think these type of specialist industries might be a bit more difficult to put your hands on exactly what's happening, right? And if you cannot get down to something where you feel like you have more than 50% probability, in other words, it's not random, then you can also just decide to leave the idea alone, right? I'll give you one example, right? Let's say printing and related support activities are contracting, right? What does that mean? Is it just printers, ink, and like printing paper? No, it also means that demand for these services is falling. But who are the end customers of the printing and related support activities? So a company like Simpress, for example, right? I think it was Bhavan who did some work on it. So basically what it does is it's going to be printing labels for goods. So let's say if you're manufacturing mugs and you want to write or draw something on the mug, they'll be the one who do that for you, right? And they also have a bit more customized or high-tech types of services that they offer. But it is essentially for companies that need to print stuff on their goods. And if they are saying that the outlook is not great, it also means that, if you look at their customers, they don't necessarily have a good outlook on the future. And it's highly likely that they would also be contracting, because otherwise they will not be cutting budgets to, these processes that are heavily product manufacturing related, right? So it's for you to kind of sift through it and go from one place to another, but always be moving to, an idea that has high likelihood of playing out. And the hardest part is that you don't get the definite answers, right? Otherwise, this report would never work. The hardest thing is you have to use your perspective and, hop into a few places before you eventually find something that, looks right. And I promise you, the more you do it, the better you get at this. Like, for example, what I've just discussed with you, it's not like I have prepared remarks for this, right? I'm just speaking on the fly. And the reason I can tell you that is because I've researched Simpress maybe 12 months ago. So I know about that. And that's kind of etched in my mind, and it's created a few more dots in my mind, which I can always connect to whatever's happening. The other thing I wanted to mention to you is printing also involves a lot of like brochures, billboards, and all this advertising type of material, right? So if demand for these types of products is declining, does it mean that advertising budgets are being cut? What does that mean? Can we find companies that have exposure to physical type of advertising products like brochures, billboards? Because a lot of advertising budgets go to online services like Facebook, Google, Microsoft, and so on. I think these would still not yet take a hit, but the physical ones, like, can we advertise in a magazine? Can we advertise in a newspaper? Right? I think these are likely to get cut quicker than the digital form of advertisement. So this reads as printing and related support activities, paper products, and so on, but it's given us a totally different direction to look at, right? The paper product thing is also related to packaging material, so these corrugated paper sheets and so on. If that's contracting, what does it mean? The goods economy is slowing down, right?
Yes.
So think about it from that perspective. Like I said, there's never any definite answer that we get, and you just need to keep exploring these leads. It's not getting into rabbit holes, it's just exploring these leads to establish whether there's validity to whatever you're thinking or not. But think about it, right? Like what was life before you had seen this slide, and let's say a couple of weeks before we discussed the ISM report? Far less, far less enabling, right, when it comes to trade idea generation. Now
so it's a massive difference. I don't think we can even compare it.
Yeah, I mean, now that you've seen it, you know, it's only going to get better from here, because you're going to be looking at this every month, and you'll get things right, you'll get things wrong, and every month you'll just get better. You'll just be able to crisscross and interconnect things a lot better, right? And that's the benefit of discussing these things repeatedly, but also in great details, and more importantly, see them work in the market, because that's when the brain is like, yeah, I mean, kill the devil's advocate. There's no point to be the devil's advocate. This thing works, and it's giving you more than a 50% probability of being right, and the kind of ideas you can find from these is just ridiculous. Just maybe to go back to Darren's question, you know, the idea of TriNet, for example. So this didn't come from the ISM. This came from us just having a view that the jobs market will be weaker in the foreseeable future, right? We could not see the jobs market expanding rapidly from here onwards. We thought that we've probably reached the peak, and even if the Fed cuts rate, it's probably just going to slow down the decline rates in jobs. So that in itself became a theme that we started exploring, and we said, okay, so if fewer people will be joining the workplace, who will suffer from that? Any company that gets a fee based on the number of people employed, right? And that's how you start looking at Insperity, TriNet, a few others. What the hell did I know about TriNet 6 months ago? Nothing. I only knew about TriNet maybe from August onwards. Never heard of that company, you know. I knew about Insperity. I've been looking at it for almost a year, but TriNet, never heard about it. And then so the real power here is you take a company that's basically just a ticker name, you have all the information at the right level and granularity to be able to understand what's the status quo and what's likely to unfold next, right? So that's the power, right? I don't even, like, in many cases, I didn't even know the company's name. I just know it as TNet, right? Now I've looked at it a few times, it's kind of in my mind, but this is basically what I'm trying to say, you know. You're literally just picking a ticker, and it's not like you've spent years researching it like analysts would do. Analysts specialize in a particular industry or sector, and they spend years looking at the same companies, filtering through it, speaking to management, speaking to, you know, C-level staff, and all of this. All of that is useless information, right? And they're just doing it to call themselves specialists, but it's not actually improving their core understanding of the company, and most importantly, what's going to move that stock, right? Whereas we are guys who are just sitting at a desk anywhere in the world. We have access to top level information, and we are forming our independent view on the company and figuring out what could happen next for the company. And on that basis, we have a much higher win rate than what the specialists supposedly who are looking at this company, this industry every single day have. That's powerful, right?
Yeah. Yeah, I remember for this one particularly, like you started with Insperity, and then you went to Corn Ferry before trying it.
Yeah. And then there was this other company called, I think the ticker
Man
is
something.
MANU.
Yeah, I remember.
Yeah. And I mean, if you look back, both Insperity and TNet have been huge winners. Not winners as in they've rallied, but they've been great shorts, right?
Great shorts, yeah.
If you shorted Insperity at 93, it got to, I don't know, 80 something. You've made serious money on this trade. TriNet is ridiculous. TriNet has a lot more to go.
Yeah.
Okay, so any more questions?
Right, thanks very much. No, that's it. Thanks very much.
Super. I'll end it here. Let's take it over in the Discord server. I hope this is helping.
It's very helpful.
Super. Glad to hear that. Okay then. Thanks, guys.